Hey guys, Dave with Moneyology here. Hope everyone is having a great weekend. Today's January 26, 2020, and these are the charts around the world. Weekend Market Review Edition. All right, so starting with a number of charts from a weekly perspective, this is the 10-year U.S. Treasury yield. So what we're looking at is a yield that was down close to 9%, 8.5% last week. So that's a pretty considerable move to the downside, which tells me that the markets are already have started a correction. We'll go through the details as to why, but bottom line is this is an opportunity to overweight your fixed income holdings, quality fixed income, as well as perhaps utilities and names that benefit from a lower interest rates, perhaps such as REITs or whatnot. But anyway, so bottom line is we could not break above the 26 EMA here and struggled even at the 13 EMA. And so here we are rolling over. I think that 1.6 is going to be a very interesting area to watch and see how we that area holds. Right now, the 38 level of RSI is going to be very critical support, and we'll have to reevaluate uh, the position at that point in time. But bottom line is rates are looking like they want to go lower. Here's the 2500 index by the Wilshire, and clearly we've been in just a parabolic up move, and so a pullback here is actually very, very healthy. Although if you're buying here, obviously that's not what you want to see. But that's kind of the risk reward you've taken if you bought here. Bottom line is, I think a healthy pullback will get us all the way down to the 7,400 level. I mean, without having a calculator with me, that's that could be a close to 6 to 7% move to the downside. But at the same time, if you look at it from a longer term perspective, very very healthy to have these sort of pullbacks to let other entrants into the market and to cool off some of the froth. Copper. So copper here was interesting. It could not make positive divergence as it made a new high here. It really basically faked out the bulls and really broke down. And the negative divergence, although hard to spot at the time, uh, could be looked at as one of the reasons why momentum was not following suit here as it was here. So bottom line is we had a very strong down week in copper, 5.7% to the downside, and and this is what we're seeing. So I think if you're looking at just this trend line here, I could see a move all the way down to around that 40 level eventually before finding some stronger support. And then again, we'll have to revisit what that's going to look like at that point in time. If you extend this particular momentum chart, I could see this potentially going all the way to that 31 level right over here if it cannot hold that 38 level. So copper looks like it might be dipping for the next couple of weeks. So again, if you're a short-term trader that's been buying in copper, we'll have to revisit that thesis. If you got a longer term time frame, then use some opportunities of pullbacks to either initiate new positions or uh, or or add to positions on the downside. Okay, so emerging markets. There's a lot of fear in the emerging markets with this virus, and mostly it's all overblown. Now, obviously, tragic for the victims, but bottom line is we had quite a run in the EM markets from low 37 to high 46 in better part of a year, and so that's been a good move. But a pullback is healthy. So again, a pullback towards that 43 level would not at all surprise me. A shakeout all the way to 41 and a half would surprise me, but wouldn't shock me, and still would be very much within a bullish thesis and bullish narrative. So, bottom line is we didn't quite hold the 61 level, down about 3.5% on the week. I think we'll probably head lower because typically markets down on Fridays, continue down on Mondays. So we'll have to watch that. But bottom line is use these opportunities as not panic situations, but rather opportunities to expand your horizon and find opportunities to buy. And we'll certainly help out with that. So gold, on the other hand, broke out from a weekly perspective. That's a very, very bullish move. Now, even though there's slight negative divergence between where we are here and the previous high, we want to give this an opportunity to prove itself and break higher. So just because it's slightly negative doesn't mean anything. However, if we start seeing a draft back, then we can say with a high degree of confidence that this is a fake out rather than a breakout. But my hunch is that this is indeed a breakout. You see PPO just having broken above zero for the first time, frankly, since in an uptrend since June of last year, right? This is the first time it started going up. So gold's in a very good spot, and definitely our portfolios are positioned with a strong allocation to precious metals. High yield bonds. So high yield bonds took it on the chin finally. This has been one sector has been so sturdy over the years, despite kind of the underlying, you know, components not being the strongest credit, hence junk. But this has been going up and up and up. Finally, we pulled back. If you look at this on the daily chart, we've got it. We've got a chart to this on our technical corner on moneyology.com. It shows that junk bonds really broke down this week. So a move all the way towards that 106, which is not that big of a percentage move. We're talking 3% potentially. Would not at all surprise me. In fact, I would be very delighted to see it because I think in the end it's going to be healthy for the markets. I think probably a pullback all the way to this trend line around 50 is I'd say 50-50 probability at this point, if not higher. So housing. So housing is very interesting because housing is a direct beneficiary of of these lower interest rates. So if rates continue going down, housing is going to continue looking good, and that's where we might start taking a look at REITs, and we'll perhaps do a premium video on the various REITs that you can buy from healthcare to construction REITs to apartment REITs, et cetera, et cetera. So bottom line is, interest rates dropping, housing looking good right now, breaking out to multi-year highs. Crude oil, on the other end, so crude oil is just been a very fickle asset class, and although we see the value in the sector, it's been tough. It's been tough every time we're looking at the sector from the downside, and we see a lot of opportunity. You think it's about to break out, and then sure enough, it pulls back and breaks down. So this right now, to me, looks like a fake breakout. So if it cannot hold support here at the 38 level, which is where support has been found in the past, then I would be concerned. If this trend line doesn't hold in price around 53, I would be concerned. PPO is is trending below zero, so um, that is concerning. Now, the other on the flip side, anytime you see a breakout to the upside without significant follow through, to me that tells me that it's not necessarily a fake breakout, but rather a first attempt at a breakout that eventually will resolve itself to the upside, especially when there's positive divergences we saw here. But we've got to go with what the markets are telling us. And right now, from a weekly standpoint, this chart does not look strong. So even though there's a lot of support around that 52, 53 area right over here, if that level breaks, I don't want to be in any energy related holdings that I can't hold for a long time. So unless you've done due diligence on a company that you know that even in the 40s will do well, there's no reason to hold at this point. So I'm going to be watching very carefully this week. We'll go through an oil and energy review, probably posted later on today on Sunday. Nasdaq. So Nasdaq still looked fairly strong. Was the strongest of the sectors, about 80 basis points down. But again, a pullback here can send shares all the way to the 8,400 level, and that could be a pretty substantial pullback. But again, would be very much needed from a longer term perspective. Okay, so you've got the 10-year to the 2-year Treasury swap. So bottom line is this is the yield curve that we talk about, and although it was on the verge of breaking out, sure enough, it didn't do so. This trend line served as resistance. 61 level served as resistance, and now we pulled back. Is the 50 level going to hold, or are we going to break lower? Time will tell, but my hunches we're probably breaking lower all the way towards that 38 level, which means that that's a indication that the markets are going to be in a corrective phase for the foreseeable future. All right, so let's see. Let's go on. All right, here's a junk to the high yield, high quality credit ETF ratio, and you see, even though we were doing quite well for some time with junk outperforming high quality credit, this ratio looks to be on the verge of a breakdown. Closed the week right below the 50 RSI level, below the 13 and 26 moving averages. So I think there's going to be, again, that's an added sign that pullback is in the cards. Look, I mean, we went all the way to the 50% Fibonacci retracement, and so on this particular up move. So a pullback here is not a surprise. Again, would be healthy for the longer term uh, time frame of the markets. Here's another TLT, deflation to inflation ratio, and you see inflation, or rather deflation, winning right now. Found support at that 50 RSI level. We said in last week's video that this looked to be bullish for this ratio and bearish for equities, and sure enough, it's proving out to take that's taking place right now. 13 and 26 week moving averages serving as support for this ratio. Looks like we're going to retest it at the 1.25 ratio level. So again, that's a net bearish indication for equities right now, and likely means that we're coming into some market turbulence. Here, consumer discretionary versus consumer staples, and while this is still in a very tight range, I would not at all be surprised to see this ratio break down. You see right now, momentum is already below the 50 RSI, could not break above that. And if this particular downtrend doesn't hold from the upside, then I would be fairly concerned. Here's the Russell 2000. So could not break above the 69 level. That's the previous breakdown level right here. That's when we broke down. Sure enough, we did the same thing here. So I think a pullback towards that 157.50 to the downside is very reasonable. Large caps S&P 500 still in overbought territory, just down 1%. And so for this one, I think a pullback towards around 31.94 or thereabout is a possibility. But if it breaks lower, I would be very pleased to see it move all the way towards that 3,025 area. Regional banks extend this trend line like this. Right now, we are at that support level, or very close to it. If that cannot hold, I think the banks are going to start moving lower, and this particular ETF likely heads towards that 53 level. You see PPO is curling very close to curling below zero. So again, you kind of look at this and you say, here's a head, here's a shoulder, here's a head, and here's another shoulder. So a breakdown is, if confirmed, would probably be fairly bearish for the markets. Semiconductors, they're not phased at all. It's pretty incredible, this move. Eventually, they're going to be hit as well. But clearly, one of the strongest sectors in the market, still up on the week, and I would say any pullback probably at its worst takes us to about 1650 to the downside. Here's the SPY. We covered the SPX. Total stock market still very bullish, only down 1% last week. But again, I would hope for a pullback, a healthy pullback towards that 152 level. Dow Transports, fairly strong on the week, only down 2%, creating higher highs here, which is positive. But if the market pulls back, you're going to see a pullback here, and perhaps this 1300 level over here will serve as support. Here's the US dollar. So the US dollar might be on the verge of a breakout here. I'm watching this very closely. This trend line from the downside, it's above the 50 RSI level right now. I'll just erase that so you see that it's above the 50 over here, and it is very close to potential upside breakout. Now, you've got price trend lines here as well that are going to serve as resistance around 98.5. But bottom line is, we're going to be very curious to see how this plays out because if the dollar goes up, emerging markets are going to get hit, and we'll see how commodities play in that space. I think the agricultural and non-precious metals commodities likely get a hit as well. We'll have to watch precious metals to see how they react under that circumstance. Developed markets, again, pulling back here, had a positive divergence here, so not concerned. I think a pullback towards the 61 or possibly as low as the 50 RSI level is very much a possibility, a growing possibility. And here's volatility. So when we pointed out last week, the volatility was creating a positive divergence here between here and here, even as the price was flat. That was a sign of volatility wanting to break higher, at least in the near term. And so we broke out. We closed the week above the 50 RSI level. I think vol is going to head towards 17. And as a result of that, you're going to see some significant, not significant, but you're going to see some pretty nice turbulence in the market. And again, for people who are in cash or want to get in, this might be a good opportunity over the next couple weeks. And then here's the Wilshire 5000. Again, bullish wedge breakout to the upside here, but looks like this was a quote fake breakout and likely heads towards that 3,500 area for longer term support. Very quickly, wanted to go through, we're not going to go through this, but just to get a sense of what's taking place in the market. This is a list of close to 300 ETFs, and we're going to rank them by momentum right now. And so the particular names with momentum right now are palladium, clean energy, home construction we covered, semiconductors, which aren't really impacted by a lot of these virus scares. So that's related, these two are related, technology. Solar's still very strong. I'm very surprised at Brazil. This is very interesting. We're going to have to dive into that later. Utilities being strong suggests that the markets are indeed looking for a pullback. Very surprised at lithium, but lithium's very strong right now. We covered that last week. Russia. So I'm frankly surprised that you've got Brazil and Russia doing quite well despite some of the turbulence in the energy markets. But that's great to see. But bottom line is you see a lot of clean energy. We'll cover that in our energy review later on today. But clean energy and technology, palladium very much tied to clean energy. So the battery markets are very very hot right now. So and that's connected to lithium. So there's a lot of connection between solar, clean energy, wind energy, palladium, and lithium. And frankly, we're going to cover that later on, which is not here. But nuclear energy is clean energy, and so there's a lot of there's something very interesting. I did notice here's the nuclear energy ETF. I frankly don't know what its holdings are, but it's looking pretty strong. So clearly these aren't the producers, but the nuclear energy sector as a whole is frankly one of the strongest right now in the market and breaking out. So a lot of talk about nuclear being dead, far from it, and I think you're going to see a really nice 2020 at some point. So anyway, that's it. Also, just very quickly on the downside, looking at what's acting weak, energy, uh, oil and gas, natural gas, coal. So you're seeing a lot of these particular names getting hit right now with the pullback in energy, and we'll cover that in a later review today to see if it's worth being invested in this particular sector right now as a contrarian play any longer. Also, another one that we've been covering before, shipping has really broken down, and that's tied potentially to energy, potentially just to the frothiness of the market in general. It's done really, really well for us, but we had to jump out of that sector in some names, and then some names we're still holding, understanding there probably is going to be additional weakness in the near term. Anyway, guys, that's it. Let me know what you think. Feedback's always appreciated. Dave at moneyology.com. For some reason, we've had some email issues, and thank you for those who have been letting us know. We're trying to fix that. Bottom line is, you can send me another email to dimatrade1985 at gmail.com. That's DIMA TRADE 1985 at gmail.com. And that's another way to get me. And aside from the comments on our videos here. So have a great week and enjoy the public preview uranium and oil and gas videos we'll publish later today. Take care.